You're watching something that hasn't happened in over 4 decades. Silver just broke through a psychological barrier that most analysts said was impossible, and what's coming next could reshape the entire precious metals market. Right now, silver is trading at levels we haven't seen since the Hunt brothers tried to corner the market back in 1980. But this time, it's not speculation driving the price. It's something far more fundamental, something that can't be manipulated away. Let me show you what's really happening behind the scenes. The silver market is experiencing its 5th consecutive year of structural deficits. Think about that for a moment. 5 years in a row where global demand has exceeded supply. That's not a temporary imbalance. That's a fundamental shift in market dynamics that's been building for half a decade. Industrial demand alone hit a record high this year at 1.21 billion ounces. And here's what makes this different from every other commodity boom you've seen. This demand isn't optional. It's not jewelry that people can choose not to buy. It's not investment demand that can evaporate overnight. This is industrial consumption that's baked into the infrastructure of our modern economy. Solar panels need silver. Electric vehicles need silver. 5G networks need silver. The green energy transition that governments worldwide have committed trillions of dollars to, it runs on silver. And there's no substitute that works as well at the same price point. Every solar panel requires about 20 grams of silver. The solar industry alone is projected to consume over 150 million ounces annually. Electric vehicles use nearly twice as much silver as traditional cars. And we're not talking about a gradual transition here. We're talking about mandates, government deadlines, commitments that can't be walked back without massive political consequences. But here's where it gets interesting. While demand is hitting record highs, mine supply isn't keeping pace. In fact, mine production has been essentially flat for years. The easy silver has already been extracted. New discoveries are rare. And the lead time to bring a new silver mine online? 7 to 10 years minimum. You can't just flip a switch and produce more silver. It doesn't work that way. Now, let's talk about what's happening in the physical market versus the paper market. This is where things get really fascinating. The COMEX, the major exchange where silver futures are traded, has been showing some unusual patterns. Open interest has been climbing while registered inventory has been declining. What does that mean in plain English? More people are making claims on silver that may not actually exist in deliverable form. It's like a game of musical chairs, except the music is still playing and nobody's quite sure how many chairs are actually in the room. The London Bullion Market Association, the LBMA, has seen similar dynamics. Large institutional buyers have been taking physical delivery rather than rolling their contracts forward. That's significant. When sophisticated players start demanding physical metal instead of paper promises, they're telling you something about their confidence in the system. Central banks have been accumulating precious metals at the fastest pace in decades. But here's what most people miss. While everyone focuses on gold, silver has been quietly outperforming. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, when this ratio gets out of whack, silver tends to snap back violently. We saw this in 2011. We saw it in 1980. And we're seeing the setup for it again right now. Let me tell you a story about what happened in 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They accumulated massive positions, driving the price from around $6 an ounce to over $50 in just a few months. The establishment panicked. The COMEX changed the rules mid-game, implementing position limits and margin requirements that made it impossible for the Hunts to maintain their positions. The price crashed, and the Hunt brothers went bankrupt. But here's what's different now. This isn't speculation. This isn't a few wealthy individuals trying to manipulate the market. This is fundamental supply and demand. You can't change the rules to make solar panels need less silver. You can't regulate away the industrial consumption that's driving this deficit. The market structure has changed in ways that make the old playbook obsolete. Think about the geopolitical context for a moment. We're living through the most significant monetary shift since the Bretton Woods system collapsed. Countries are diversifying away from dollar reserves. The BRICS nations are exploring alternative payment systems. Trade wars are fragmenting global supply chains. And in times of monetary uncertainty, precious metals have always been the ultimate safe haven. But gold gets all the attention. Gold is what central banks report. Gold is what makes headlines. Silver flies under the radar, which means it's still relatively undervalued compared to its industrial importance and monetary history. Here's something most investors don't realize. Silver has a dual nature that makes it unique among precious metals. It's both an industrial commodity and a monetary metal. That means it benefits from both economic growth and economic uncertainty. When the economy is booming, industrial demand drives the price. When there's a crisis, monetary demand kicks in. It's the only metal that wins in both scenarios. And right now, we're seeing both dynamics at play simultaneously. The green energy transition is creating unprecedented industrial demand. Meanwhile, monetary uncertainty is driving investment demand. It's a perfect storm of factors that all point in the same direction. Let me paint you a picture of what's happening in the physical market right now. Dealers are reporting premiums over spot price that haven't been this high in years. Wait times for physical delivery have extended. Some products are simply unavailable at any price. These are the signs of a market that's tighter than the official statistics suggest. When you can't get physical metal even though the paper price says it should be readily available, that's telling you something important about the disconnect between perception and reality. Now, I want to take a quick moment here because this is relevant to what we're discussing. If you're sitting on a significant retirement account, 6 figures or more, and you're concerned about monetary instability and inflation eroding your purchasing power, I put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers the mechanics of getting physical precious metals into your retirement account without triggering tax penalties, the custodian requirements, and the storage considerations. Worth checking out if that's relevant to your situation. No pressure, just information. All right, back to where this market is headed. The supply deficit isn't going away. In fact, it's projected to widen. Industrial demand continues to grow as the green energy transition accelerates. Mine supply remains constrained. And now we're starting to see investment demand pick up as more people recognize what's happening. This creates a feedback loop. Higher prices attract more investment demand. More investment demand tightens the physical market further. Tighter physical markets lead to even higher prices. And unlike 1980, there's no easy way to break this cycle because the industrial demand is non-negotiable. Let's talk about the technical picture for a moment. Silver recently broke through resistance levels that had held for years. When a market breaks out of a multi-year consolidation pattern, it tends to move fast and far. The momentum indicators are showing strength. The volume profile suggests institutional accumulation, and the price action is displaying characteristics of a market in the early stages of a major move. But technical analysis only tells part of the story. The fundamentals are what give you confidence to hold through the volatility. Here's what keeps me up at night, in a good way. Most investors still don't own any silver. The percentage of portfolios allocated to precious metals is near historic lows. When this trend reverses, when mainstream investors start allocating even a small percentage of their portfolios to silver, the available supply will be overwhelmed almost instantly. The entire above-ground silver market is tiny compared to global financial assets. If just 1% of global investment capital decided to allocate to physical silver, there literally isn't enough metal available to satisfy that demand at current prices. The price would have to rise substantially to ration the available supply. This is basic economics. Inelastic supply meets surging demand. The only variable that can adjust is price. Now, let's talk about what could go wrong. What are the risks? What could derail this thesis? A global recession could temporarily reduce industrial demand, but even in the 2008 financial crisis, silver's industrial demand only declined modestly before recovering. And the monetary demand during a crisis would likely offset any industrial weakness. Technological substitution is always a possibility. Maybe someone invents a cheaper alternative that works as well as silver in solar panels and electronics. But after decades of research, silver remains the best conductor of electricity at a reasonable price point, and even if a substitute emerged tomorrow, it would take years to retool manufacturing processes. Government intervention is another risk. Could authorities try to suppress the price like they did in 1980? Possibly. But the market is much larger and more global now, and the industrial demand creates powerful constituencies who need affordable silver. It's a delicate balance. The most likely scenario, in my view, is that we see continued volatility with an upward bias. Silver doesn't move in a straight line. It's notorious for sharp corrections that shake out weak hands. But the underlying fundamentals support significantly higher prices over the medium to long term. Let me give you some context on where prices could go. Some analysts are targeting levels that sound absurd until you understand the math. If silver simply returned to its historical ratio with gold, we'd be looking at substantially higher prices. If it matched the inflation-adjusted high from 1980, we'd be in triple digits. If investment demand reached even a fraction of what it was during previous precious metals bull markets, the available supply would be exhausted quickly. I'm not making predictions. I'm showing you the math and letting you draw your own conclusions. But here's what I know for certain. The setup we're seeing right now is rare. The combination of structural deficits, record industrial demand, constrained supply, and growing investment interest doesn't come along often. The last time we saw something similar was in the lead-up to 2011, when silver went from around $17 to nearly $50 in less than a year. Could we see a similar move? The fundamentals are actually stronger now than they were then. The deficit is larger. The industrial demand is more entrenched. The monetary uncertainty is more pronounced. And the starting price, while higher than 2010, is still well below the inflation-adjusted peak. Here's what sophisticated investors are doing right now. They're accumulating physical metal quietly. They're not chasing momentum. They're not trying to time the exact bottom. They're building positions methodically, understanding that the long-term trajectory is up, even if the short-term path is volatile. They're also diversifying their exposure. Some physical metal for insurance, some mining stocks for leverage, some ETFs for liquidity. Different vehicles serve different purposes in a well-constructed portfolio. The mining stocks are particularly interesting right now. When silver prices rise, mining companies see their profit margins expand dramatically because their costs are relatively fixed. A 20% increase in the silver price might translate to a 50 or 100% increase in mining company profits. That's the leverage that makes mining stocks attractive during precious metals bull markets. But you have to be selective. Not all mining companies are created equal. Some have high costs, poor management, or challenging jurisdictions. The quality operators with low-cost production and strong balance sheets are the ones that tend to outperform. Let me bring this back to the bigger picture. We're living through a period of unprecedented monetary experimentation. Central banks have expanded their balance sheets to levels that would have been unthinkable a generation ago. Government debt has exploded. The purchasing power of fiat currencies is being systematically eroded, and the traditional safe havens are showing cracks. In this environment, hard assets with intrinsic value become increasingly important. Silver, with its dual nature as both an industrial commodity and a monetary metal, offers a unique combination of characteristics that are difficult to replicate. The green energy transition isn't going away. The monetary uncertainty isn't going away. The supply constraints aren't going away. These are long-term structural factors that will continue to support higher prices regardless of short-term volatility. Now, I want to be clear about something. I'm not telling you to bet the farm on silver. I'm not suggesting you liquidate everything and go all in on precious metals. What I'm saying is that the risk-reward profile right now is compelling enough that it deserves serious consideration as part of a diversified portfolio. The downside is relatively limited. Silver has industrial value that provides a floor. The upside, given the supply-demand dynamics and the monetary backdrop, is substantial. That's an asymmetric bet worth taking in appropriate size. Here's what I'm watching going forward. I'm watching the physical premiums. When premiums over spot price start expanding, that's telling you the physical market is tightening. I'm watching the ETF flows. When investment demand starts accelerating, that's a sign that mainstream awareness is growing. I'm watching the mining stocks. When they start outperforming the metal itself, that's often a signal that the market is anticipating higher prices ahead. And I'm watching the macro backdrop. Currency volatility, geopolitical tensions, inflation expectations, real interest rates. These are the factors that drive precious metals sentiment over the medium term. The setup is there, the fundamentals are there, the technical breakout is there. What happens next depends on how quickly the market recognizes what's already happening beneath the surface. Silver is doing something that most analysts said was impossible. It's breaking out to new highs despite a strong dollar. It's attracting investment demand despite rising interest rates. It's defying the traditional correlations and relationships that have governed precious metals markets for decades. That tells you something important. It tells you that the underlying dynamics are powerful enough to overcome the usual headwinds. It tells you that this move has legs. It tells you that we might be in the early stages of something significant. The question isn't whether silver will go higher. The supply-demand fundamentals virtually guarantee that over time. The question is how high, how fast, and how volatile the journey will be. Those are unknowable. What is knowable is that the current setup offers a compelling risk-reward opportunity for those willing to endure the volatility. This is the kind of opportunity that comes along once or twice in a generation. The last time we saw something similar was over a decade ago. Before that, it was the late 70s and early 80s. These cycles are rare. They're driven by fundamental imbalances that take years to develop and years to resolve. We're in the middle of one right now, and most investors are completely unaware of what's happening. They're focused on stocks, on crypto, on real estate. They're not paying attention to the quiet accumulation happening in the precious metals market. They're not seeing the structural deficits. They're not connecting the dots between the green energy transition and silver demand. That's actually good news for those who are paying attention. It means there's still time to position before the mainstream catches on. It means the easy money hasn't been made yet. It means we're still in the early innings of what could be a multi-year bull market. But time is running out. The breakout is happening now. The fundamentals are aligning now. The technical setup is confirming now. Waiting for more confirmation, waiting for lower prices, waiting for the perfect entry point. That's a strategy that often results in missing the move entirely. Silver doesn't wait for everyone to be comfortable. It moves when the fundamentals demand it, and right now, the fundamentals are screaming. So here's what you need to understand. This isn't about getting rich quick. This isn't about speculation or gambling. This is about recognizing a fundamental imbalance in a critical market and positioning accordingly. It's about understanding that when supply can't meet demand, prices have to rise. It's about seeing the bigger picture and acting on it before it becomes obvious to everyone else. The silver market is about to do something that most people think is impossible. It's about to prove that fundamentals still matter, that supply and demand still work, that markets can't be manipulated forever when the underlying reality is undeniable. And those who recognize what's happening right now, who understand the forces at play, who position themselves accordingly, they're going to look back on this moment as a turning point. Not because they got lucky, but because they paid attention when others weren't, because they understood the fundamentals when others were distracted, because they acted when others hesitated. The moonshot isn't coming. It's already here. The question is whether you're going to be part of it or watch it happen from the sidelines. The setup is clear, the opportunity is real, and the clock is ticking.